The market doesn't just move randomly. It moves to take liquidity. Let me show you this. Every high or low that you see in the market is not a real high or low. You have to focus on the highs and the lows that have been able to sweep liquidity. If I say sweep liquidity, I mean the highs that has taken out some lows, previous lows or previous highs before. If you look at this market structure here, this high here was able to take out this low. From this high, we trace price down, like how the candles were being printed. So it was able to take out this low, and it also took out this low. That means that from this high, market traded down and took liquidity from these two lows, and after that it moved to the upside. This is what you want to see. If you see this, all you have to do is to mark this high and then come here and mark this low. These two determine your major highs and then your major lows. So you are now waiting for the market to create a high. It will go up and create the highest high, which will now become the trading range. So it's like this now is going to become your trading range. It will find its way all the way back to the liquidity and then continue the move. But where is the liquidity? The liquidity is the low that breaks the high that you identify first. So if we look here, we want to always trace price the way it is being printed. So from this, we trace it up to this candle here, and then we follow the red candles down to the last low, and then we push all the way up. We are just following price by the candle print, just like that. So if we draw it this way, you can see that the low that led to the break of that major high we identified here earlier is this low. So we want to identify that low as our liquidity low. The market will travel and go up and do all sort of things and come back to this low. If there is going to be a major move, it will like to take out this liquidity before this major move happens. So we identified this low as our liquidity low because it took out this major high, which we said it has taken out these previous lows. And this as a major low because it broke the major high that we marked earlier. Now this becomes our liquidity. Market travels and then did all this work here. You can also trade this using the same technique in the lower time frames, and you'll be able to still get the same technique. So from here, all you are going to do is to wait for the market to come back here, take this liquidity, and then you can get in. So from here, we can see that the market traveled all the way, and when we push, we can see from this point, it tapped into the liquidity. After taking the liquidity, that was it, and it moved, see, aggressively to the upside, and then continue all the way to the upside here. So you can see all this big move started from this liquidity low here. So your job is to be able to identify the right major high and the right major low, or you can call it the valid major highs and then the valid major lows. The low or the high that breaks that major high or low becomes your liquidity. Price will travel and comes back to that particular point, and then we'll have our buy incoming. So you need a lot of patience to be able to trade this way, but it always pays because the risk to reward is always crazy, and when you wait, you get paid very, very much. Your first target could be this major high that was created here, because that was the highest high it created before this low was being created, and you can close partials there, and then you leave a runner to the upside. So this could be a very, very good trade. And if you now want to look at the market structure here, you can see that from this point we came all the way down, and then these structure points here are internal structural points. You can trade them, but in the lower time frames, and you still need to understand that you are trading within these major highs and then major lows. So whatever is inside there is going to be minor structure highs and lows within this major structure highs and lows, and you need to understand that. So this high was the highest high it created. That's why we are marking that. And then we are coming to mark this low here now as the low, because this is the low that led to break this high here. So if you mark it like this, and then we mark this low as the major low, so we have structure starting here, we come down, move all the way to the upside, we come there, and then we push. But when you look at this place again, you can see very well that there is a low that caused the break of this high here. So you are going to identify this low again as what? Liquidity. And anytime the market comes back to that low, you are going to see that the market will react the same time. It will react. From here, we got a reversal, but even before the reversal, you can see how this candle has reacted to that liquidity from this place before it broke it down. When you add storyline to it, you will know that, okay, maybe from this point we are coming from a weekly level or a daily level. Hence, if this level is an H4 level, it's going to break it all the way down. So we will get to the storyline and be able to understand what to do, which trades to hold and which trades not to hold. And then we'll be able to know what exactly to do when it comes to market structure, when it comes to liquidity, and when it comes to understanding the direction of the market. If this makes sense to you, subscribe, give a like, and let's build the channel together. There is a lot of knowledge I'm going to be dropping inside here, and trust me, you will not like to miss out.